What's going on, guys? My name is Julian Young. I am the host of the Blockchain Brief, where every episode we are interviewing innovators and founders in the blockchain and crypto space. Today, I'm very excited to have Chris Kavalik, the CEO of CoinTaxes. Now, CoinTaxes is an automated tax preparation software for cryptocurrencies. Chris, it's great to have you here on the Blockchain Brief.
Hey everyone, thanks for having me on the Blockchain Brief. It's a pleasure to be here.
Yeah, this is actually perfect timing, as I'm sure everyone right now is scrambling to figure out their tax situation for the crypto world. So again, this is great to have you here. Let's jump right in. Give us a little bit about your background and how you ended up starting CoinTaxes.
Sure. So I used to work for Sir Richard Branson at the Virgin Group, and I was actually on his business incubation and venture capital teams. I really enjoyed working with startups. I made an angel investment around that time as well. So I ended up starting a incubator in New York City called Series X. I co-founded that with two of my partners. And now I've fully made the leap into entrepreneurship with my own venture as CEO of CoinTaxes.
Fantastic stuff. And so I think the problem is pretty obvious, but why don't you walk us through? What are you trying to solve here with CoinTaxes?
Well, there's three big problems in the cryptocurrency space that we're trying to address. I think the first one is that you have kind of FOMO adoption, right? These are people who, for the fear of missing out, are jumping into cryptocurrencies. Coinbase had 9 million new accounts in the last 18 months. And these people, a lot of them may not be blockchain literate. They might not even be financially literate. This could be their first investment ever. As Christopher Giancarlo, chairman of the CFTC, said, his own kids couldn't be bothered to invest in stocks, but they were really drawn to cryptocurrency. And so, when we were entering the ecosystem, we wanted to make sure that we were taking into account the user base's potential literacy level of blockchain and finances in general. So that's one thing. The second thing is, because cryptocurrencies are so new and kind of the Wild West, as it's often called, there's a lot of misinformation, bad information, even illegal information that's out there, which has gotten to the point where Facebook has now issued a blanket ban across anything related to ICOs or cryptocurrency. And it's so bad now that even when Coinbase, who's a trusted figure in this space, tries to do something like issue 1099Ks and communicate with their user base, the first reaction is this a scam? I don't understand. It doesn't make sense, et cetera, et cetera. And when you combine misinformation with kind of an inexperienced user base who's kind of rapidly growing by the day, you're bound to end up with non-compliance, right? So in 2013, there were less than 900 taxpayers, according to the IRS, who filed the cryptocurrency taxes. And the IRS responded by issuing a notice in March of 2014. This is now almost 4 years ago. Their stance on cryptocurrencies, explaining that they're expecting it to be taxed. Despite the IRS issuing this, right, people just didn't care, to be honest. They considered it fake news, or they didn't think that the IRS was going to track them down, and essentially less than 900 people, the same number, filed in 2014 and 2015. And the IRS has now had enough, frankly. You heard about the court ruling against Coinbase, where they were able to get the records of their higher volume trading customers, and they're going after the entry points, the on-ramps into cryptocurrency, and they're also forming task forces. And so if the IRS is going to send cops to chase people down, we wanted CoinTaxes to be the good cop in that game, and to help educate people and inform them, what do they have to know, what is the responsibility that they have to take, and to automate as much of that as possible for them.
Yep. I remember when I started basically downloading all of my trades from the different exchanges and thinking there had to be a better way. So when I saw you post about this, I said, I'm calling Chris, because this is a 10x easier solution. So let's walk through that, right? So if I were to go on to CoinTaxes, how is it better than the solution now? If I was a normal person not using you or Bitcoin Tax, how would I go through it? And so how do you make it easier for consumers using your software?
Well, I think it's really important to understand what is the burden that you have to go through in the first place, right? I think most people, there's a misconception. Okay, if I put in my fiat, my US dollars, say put $100 in, I make a bunch of cryptocurrency trades, and I pull out $200, that's easy. I don't need a calculator for that. I put in 100, I took out 200, I have a $100 gain, done. Unfortunately, that's not the way it works. every transaction that you do where you are receiving a coin and then getting rid of a coin, and by getting rid of it's technically called a disposal in tax parlance. Whether you're trading it for another coin, for a coffee, anything, that's a disposal. That is a taxable event. And so you have to keep track of every single coin trade you've ever done. And the IRS doesn't think about prices in terms of Ethereum or BTC or any altcoin. They think about it in US dollars. So now you have to get the record of every transaction you've ever done. And on a as accurate basis as possible, you have to show what was the US dollar value of that transaction at that point in time. And the IRS has said, well, you can use the average, daily value, essentially, right? But the thing about that is, if you have multiple trades in the same day, you can't use the same US dollar value for that coin. So you have to get to a more granular level, ideally at the point of the exact time. And there's a few other things you have to keep in mind, which no exchange can give this information to you. If you're on Coinbase, for example, they can see your buys and your sells, your deposits and your withdrawals, but they only see what's inside their ecosystem, right? If something's coming in or coming out the other way, they can't allow you to basically underpay your taxes, so they have to be as conservative as possible. So they're saying, okay, anything that's coming in as a cost basis of 0, meaning they're assuming you got it for free, and if you sell it, you're going to have to pay full capital gains on the entire value of that coin. Anything that's coming out, they're assuming that was not a gift, it was not a donation, it was not a transfer to another wallet or exchange, that was a taxable event, and so we're going to consider that a taxable event. And so you can't rely on the exchanges. You have to go into all of your different transactions. You have to get the US dollar of everything. There's a few things that I'm kind of leaving out here, but you get the gist that there's a lot you have to do. CoinTaxes essentially automates all of that I was just talking about. And you just easily go onto the platform. It's a web application. You sign up, you go online, you can upload your transactions from your exchanges, upload your transactions from your wallets, and we'll automatically create one giant master ledger of all of your trades, identify transfers between, that's the inflows and outflows, and if there's something that we don't know what it is, we'll ask you and help you identify those things so you can make sure you're not overpaying your taxes. And for example, a gift or a donation are not taxable events if they're even though they are at a disposal and you're getting rid of it and you're transferring ownership. So want to make sure that we're, again, automating it and educating you so you understand what's happening.
Got it. No, that's very, very helpful, I'm sure. So have you actually started launching this project now? Like, can people go online and sign up for CoinTaxes?
Yes, I would recommend you do go to cointaxes.com. The product is going to be out in about 12 days now, and or depending on when you air. So it should be out in early March. And yeah, you can go online. If you go right now, you can get actually 30% off before we launch. So the full price is $50. And if you go now, you would get it for $35.
Very good. So I think there's something, especially with the new tax law passed back in December of the 23rd. I think there's a lot of confusion in terms of, when do I need to report like-kind transactions, right? Or if it was transactions before the 23rd, is it not really considered like-kind? But then after the 23rd, let me repeat that. Before the 23rd, it was considered a like-kind transaction, but after the 23rd, it might not be considered a like-kind transaction, right? So what's your advice to people that are sort of confused as to how to report it, right? Like, I think the biggest issue here is there's so little clarity from the IRS in terms of like what's taxable and what's not. So I don't think people necessarily know what to do, right? Or are they putting themselves in a position where they're creating more of a tax burden for themselves, right? Whereas, so I don't know if you wouldn't mind speaking to that.
Let me jump in and kind of help you with that. So I think the first thing is, this is some of the misinformation that I was talking about. The notion that like-kind exchanges is a special kind of treatment that somehow cryptocurrencies can apply for. That's not true. It's not true going forward, and it's not true retroactively either. So let me just explain why that is. So a Section 1031 exchange is considered a like-kind exchange, and it was written for real estate property. And the law change that you're talking about that was recently passed by President Trump explicitly says that this is just for real estate transactions and just real estate property. However, there were analogies in the past where non-real estate assets were taking this special treatment, where a transfer of goods wasn't actually a taxable event. Here's the problem, and why it doesn't apply to cryptocurrencies. The only analogies that are out there are for gold coins and silver coins and actual, precious metals that have been exchanged. And the problem is that they were specified on such a level of detail to look at the precious metal as a percentage of total mass of the coins being exchanged that there's no way that could possibly apply to a Bitcoin versus an Ethereum, or one ERC20 token to another, because they all have extremely different characteristics and nature are the two kind of parameters you have to keep in mind. So there's almost no way that would apply retroactively, or as well as going forward. So that's one key area of misinformation. Actually, all of your trades, one coin to another, are all taxable. And you, as I just said earlier, you have to find the US dollar value of every trade that you did, because they are all taxable. I do want to make one point here that, even though we're talking here about taxes and what you should be doing, this isn't tax advice, isn't legal advice or financial advice, and it's not a substitute for getting a professional to help you. So if you are planning on making any decisions, you do need to talk to a financial, tax, or legal professional.
Great. And let's talk about some other potential misinformation, right? So I have a scenario where, I purchased X, Y, and Z coin. It's gone down significantly in price. And if I go ahead and sell that coin, realize that loss, and then buy back in right away, how is that considered? Is that a write-off, that loss, even though I went right back in and purchased that coin, or is that not allowed?
So I think what you're hinting at is wash sale rules, right? And this kind of comes back to another idea that people need to understand about digital currencies. So digital currencies, and take a step back, are this new category of assets, right? And in the United States, we have three different regulatory bodies: the CFTC, which focuses on futures and commodities. We have the Securities and Exchange Commission, which focuses on securities like stocks and bonds. And then we have the IRS, which is focused on, just from a tax perspective, about any kind of income that you're generating as an individual. And all three of them have a different way of looking at what cryptocurrencies are. So for the CFTC, they're considered commodities. For the SEC, they're considered securities. The chairman, Jay Clayton, said that all of the ICOs that he'd seen would be considered a security, which is very concerning. But then if you look at the IRS, they said that everything is property. And so when you're talking to any one of those different government agencies, a cryptocurrency is a different thing to them, and have different rules. So wash sale rules is a taxation treatment that applies to stocks and securities, which the IRS does not consider digital currency to be. They consider it to be property, which is neither of those two things. So wash sale rules don't apply. And a wash sale is exactly the example that you talked about, which is you have something, a security or a stock, you sell it to realize a loss, and then you buy back into that position within a span of 30 days on either side, in the past or in the future, from when you made that sale. One thing you do have to keep in mind, though, is that there's something called the economic substance doctrine, which basically says that any transaction has to have economic substance behind it and can't exist solely for the benefit of taking a loss or basically altering your tax liability. And so that's a pretty tricky thing you'd have to keep in mind. If you have a trade where you've exited a position and then split second later gotten back in and the price is substantially the same, you wouldn't really be able to argue that that was an economically substantial transaction. However, if you made a trade, several minutes or hours later or days later, and the prices moved, 1, 2, 5, 10%, you could easily argue that that trade to sell and then buy back in at a meaningfully different price was economically substantial.
Got it. Thank you for clarifying that.
Yeah.
Let's talk about airdrops, right? Because all these different companies now are just dropping in coins to all these different wallets. So what do you do about those?
So the way that we treat it on our platform is thinking about it from an investment perspective. So you've now been given this property, but you didn't pay anything for it. So you didn't pay anything for it, so your cost basis is zero. And then when you do sell it, you would have a capital gain or loss. But between the time that you get it and the time that you sell it, there's no tax event. The alternative to thinking about this could be, well, if I was airdropped a currency or if I was given a hard fork, you could look at, again, the US dollar value at the time that you received it. There's a lot of problems with that. First of all, it's not very clear. You might have a timestamp for when you got it, but you're not going to know exactly what the price was at that time because sometimes it's pre-sale before there's a public market available for some of these coins. For example, Coinbase didn't list Bitcoin Cash for months after it was hard forked. And the other problem is if there is a price, what is a realistic liquidity? Bitcoin Cash, because there was so little liquidity and there's a lot of hype around it, I think it shot up, from like $200 to like $800 on that day that Coinbase allowed it, for example. And so how realistic were those prices when you actually got that coin? So sure. Our approach is there's no income that you would have to pay because you don't know what the value of it really is. And so we'll just take a cost basis of zero, meaning you got it for free. And then if you sell it, you would have to pay capital gains tax equal to whatever that difference is between the price of when you sell it and zero.
Got it. And then so another one that I have, just because, we're obviously looking at a lot of private sale investments, a lot of these different ICOs. What do companies that are selling these tokens, they need to think about from a tax perspective, right? Like, because essentially they're creating all of this new value by selling these coins. Like, are those tokens that they sell, is that taxable for the business?
So I want to caveat my answer on this just by saying that I focus more on the individual, a taxpayer for a trader or miner of coins as opposed to an issuer. But as far as my understanding goes, you're in one of two buckets. Either bucket one, you are by doing an ICO, you are conducting a registered public offering of securities. In which case you're effectively a publicly traded company, and you may have to comply with the SEC regulation on that, public reporting requirements and accounting requirements, which is a huge pain. But in that case, if you're selling securities, that's not taxable, right? It would only be taxable if on the secondary market for someone who bought those your tokens. But on the other side, if you're not a security and you're effectively selling, a coupon or a mileage point or a loyalty point, like an airline or a hotel might, then you have to pay taxes on that because that's basically unearned revenue that you have now generated for your product in advance.
Yeah, it's the IRS is going to have quite a bit of stuff for them to think about. It's going to be interesting. And then also, just for the sake of keeping an eye on the time here. So what happens if, I owe a significant amount of taxes from last year, say 2017? We obviously saw quite a precipitous drop early 2018. The cryptocurrency market shed close to half of its value. So, in that case, I have to sell most of my crypto funds to cover that, right? Like, is that what you just have to do? Is there just no other way around that?
Well, I mean, in any particular case, I would always recommend that you talk to a tax professional, right? Because they're depending on what exactly the specifics of your case are, you may or may not owe as much taxes as you think. But generally speaking, if you have a number of trades in November, December of last year when we were at an all-time high, and you were trading coins, even just trading coins, right? We talked about that being taxable. You generated likely a very substantial capital gain for yourself that you realized by trading, November to December. And now that it's crashed, that's extremely unfortunate. But the IRS, frankly, doesn't care. You have a tax bill you have to settle now. The problem is by selling your coins now, you are going to be generating an additional potential tax implication.
Oh, interesting.
So, the best thing that you could hope for is that you generated a loss by paying your taxes, which you can then use to offset your income partially this year, or any capital gains you have this year or in the future.
Chris, this is awesome stuff. So if people want to get a hold of you or have additional questions, what's the best way to get in contact?
I'll give you three ways of getting in touch. One is email, Chris, CHRIS, at cointaxes.com. You can also follow me on Twitter or my company on Twitter at CoinTaxes. My personal handle is at CA Kovalik, Kovalik. And you can also learn more about us at www.cointaxes.com. So
awesome stuff. And we'll make sure we include all of that in the newsletter as well. So any one of our viewers that are interested will be able to get a hold of you easily. Well, Chris, thank you so much again for taking the time. Really looking forward to tracking the progress, and thank you for helping to build out this tool that everyone, I'm sure, is going to need to use.
Thank you. Thank you so much for having me.